I'm Lydia Bayud. I'm a fintech and financial services reporter with Bloomberg Law. We're going to be drilling down a little bit more into the proposal to transform the DBO into the DFPI from the Newsom administration. And we've got the panel to kind of give us their initial reactions on something that's still in flux. We're also going to leave some time at the end for audience Q&A. So please think of any questions that you might have for the panelists. And of course, some of those questions hopefully might be answered by Edgar Gill after we're done. So without any further ado, I have Clint Rockwell, who's a partner at Buckley, Armen Meyer with Lending Club, got Campbell Gibson at Avant, and last but not least, Chris Peterson with the Consumer Federation of America. If you want their full titles, you can look to my left, to my right. So Chris, I'm going to start with you. I think you can give some interesting context about how the Newsom proposal came about and some of kind of the thinking and work that you did on this. Why don't you kind of fill the audience in a little bit on how we got to here?
Sure. Yeah. So first off, thanks for the invitation. Thanks for it's fun to be here. It's fun to meet with you all. Thanks to Con Hurley for the invitation to come over. So I worked at the CFPB for about 4 years, and I'm also a law professor at the University of Utah, and spent a lot of time building that agency. I know not everybody's a fan, but I was kind of proud of it, and sort of sacrificed for a long time to try to make that thing happen and start to run, as did many other people, obviously. So it was hard for us that worked on that to see, maybe it being dialed back in a number of different ways. So when that became clear that was going to happen, a conversation started happening out here in California and other places around the country about whether or not there's something similar to what has happened with air quality standards, where California can sort of set its own agenda and preserve some of the same kind of elevated protections in California. And so that was the concept. So myself and a number of other people, Diane Thompson, who was the acting director of the regulations office, some folks from NextGen here in California, Dr. Cordray, Rich, and I also some California advocates out here. We got together and started brainstorming. If you were going to try to recreate the Dodd-Frank Act, Title 10, and the CFPB, and do it in a California context, what would that look like? And we sat down and we wrote a bill together. And then eventually we went and shopped that. Commissioner Alvarez and I used to work together at the CFPB, went and shopped that to him. And then I think somehow that made its way over to the governor's office, and now there's a bill. And it's not, what we wrote is not exactly the same thing. There's some real differences, but there's a lot of language that sure looks familiar. What would it do? I mean, the bill is that the governor has sent over. It essentially replicates a lot of the same kind of broad-based authorities that the CFPB has. It sets out a list of enumerated state and federal laws, not just the federal laws, but the state laws as well, and some concepts of financial services, and creates some pretty comprehensive regulatory oversight as opposed to supervision and enforcement authority, and contemplates some revenue sources for the agency to come into being. And I'm certain that there are a lot of people in the room who would be thinking to themselves, look, do we really need 50 CFPBs? Isn't one enough? I know you feel that way, but in my defense, arguably there's not going to be one CFPB depending on what happens. So, one CFPB in California and none in DC is better than none anywhere from a consumer protection perspective. Anyway, so that's a little bit of background on the proposal.
Well, Clint, I can see that you have marked up the trailer bill. Like, there is extensive notes in the margin. So I kind of want to get in some first impressions from you all, from the panelists and industry. Like, what do you see as the biggest, kind of the most impactful provisions in here? Let's start with you.
Well, I think there's a lot here, even if it's not exactly what you came up with, Chris. I think there's a lot in there, and a lot of it does look familiar. Interestingly, in California, the way that the department kind of draws its authority presently is kind of a patchwork, right, of different, we're a patchwork within a patchwork. And so the DBO inherited all of these kind of enumerated laws. The ones that probably most of you are familiar with in this room that I'll use it as an example is the CFL, which is itself a patchwork of 3 different laws that were merged in the 90s. And so this kind of, and we're in the weeds a lot in the licensing world and in the enforcement world and providing regulatory advice on a daily basis on these laws. And it's very tricky. There's a lot of history. There's a lot of, well, yes, this is what the words say, but there's this commissioner's opinion or there's this enforcement action that provides additional context. And so one of the interesting things about this is going to be just like the practical effect of instead of looking first to, okay, where's the authority of the commissioner to regulate this activity? It's, that's kind of a given if you are either engaged in a consumer financial product or service, or you're, my favorite provision of this, of the Consumer Financial Protection Act, service provider of somebody who does that, which is basically everybody in the world. And so that's a given, right? And then you go to the kind of the next step. So a lot of the technical discussions we have about, the CFL and how provisions work and kind of that context and history, I think it's going to shift a lot to just kind of a more of a general UDAP standard. It's not to say, that the DBO doesn't have tools. I mean, it has a lot of tools. There's a lot of and I think, in my experience, the enforcement authority has been very, very active in recent years, but this signals that will become more active. I think there's also kind of just practical issues with, in the budget, they talked about 9,000 additional registrants. So, all the real estate brokers that are currently unlicensed under the real estate broker law, which is, not regulated by the DBO, are going to be under the DBO's purview. And moving those over, the practical issues associated with licensing those people or registering those people is going to be a big lift. There's going to be a lot to do for the department and for the industry.
Chris, did you want to respond?
No, I think I pretty much agree with that. I also add debt collectors is another group of registrants where there's a lot of them out here, and I don't believe they're currently paying any registration fees to DBO. That's a significant source of revenue. And I think I loved your analogy about, in fact, that was in my mind when I was, when a bunch of us were working on a similar proposal that's not the governor's proposal. But and so many people in California know this much better than me, but the law is built like a house where they're just putting new add-ons, new additions here and there. Let's put a kitchen here, and then we need another story over here, and it all doesn't integrate very well. This proposal, I think, is a way to kind of come in and revamp that, redo all the plumbing, and make sure that the agency that was the DBO has a pretty comprehensive suite of authorities to do whatever they need to do to, regulate, supervise, and enforce the law, and also some pretty big sticks to make sure that folks comply. I recall we lifted the civil money penalties verbatim from the Dodd-Frank Act. So
yeah, I think one of the questions I had when I was reading it is it's kind of sitting on top of the existing infrastructure, right? And if I'm a mortgage lender in California, I can choose to be licensed under one of 3 laws. I can choose to be licensed under the RML, the CFL, or the real estate broker law. And I guess one of the questions I had when I was reading it is, well, is it better to have this thing kind of sit on top of this existing infrastructure that, as you said, if you think the CFL is bad, the real estate broker law, which dates back to like the late 1800s, is really bad. Would it make sense to kind of consolidate and provide a little bit more, kind of a linear authority for the different types of lending, and in addition to debt collection, right, merchant cash advance, factoring, all of these things that have been a little bit on the periphery are kind of brought in. Would it make more sense to have a little bit of more of even a more drastic change in terms of consolidating some of these laws, which can conflict with each other and are difficult to manage?
This works, right? Okay, great. Armen Meyer at Lending Club. Chris, appreciate what you guys came up with in California. In a prior life, I was a regulator. I was chief of staff of New York's bank regulator. At that time, we were called the New York Banking Department. Right after Dodd-Frank passed, we had a similar thought process. Sure, you mentioned, maybe we don't want a million states out there creating as many CFPB. But having more eyes and cops on the beat is a smart idea because there's a limited amount of enforcement capability of wait and see. Two, you don't know when things wax and wane at the federal level, and our position back then was states need to step up in times like that. This is distinguished sometimes from the patchwork and the weird licensing provisions and the vestiges, in my opinion, but cops on the beat is certainly a really important thing, and definitely applaud what California is doing there. Also, to the licensing point, sometimes the old laws don't capture new activities, and an important thing for us in New York, when we passed our version of this, is similar to what California is doing here, which is, why are we only regulating by licensee? Should we not have power over products themselves? And I would say that that's an important thing for an agency to have, because sometimes the licensing regime is not the right solution to a problem, and you end up square pegging into a round hole without the power to regulate products and investigate products. One thing that we didn't do in New York that California did, that I wish we did in New York, was equating, in some respects, regulation and innovation. This agency has the word innovation in its title. In the first page, innovation is written several times. It's one of the pillars of the agency. I wish we did that in New York. We've seen New York come around a bit, and I applaud what Lynn Lacewell has done in terms of bringing up innovation more often and making up for some lost ground there. But why is that so important? It's because if we view innovation and consumer protection as separate things, I think we end up in the wrong place. There's a lot of examples of regulation that's actually pro-innovation. A major example I think is familiar with many people in this room. I think I saw Opportunity Fund earlier. I see Lewis from Lending Club. I see members of the Responsible Business Lending Coalition and Marketplace Lending Association who got together and passed a pro-regulation and pro-innovation bill to make sure APR is disclosed in the small business world. That not just helps consumers, it also makes sure that there's price competition and real competition so that people are innovating and encouraged to innovate to get the best products to people because they know they're going to win in the end with a better product, not because of legal evasion. So that's an example of the type of thing that should be encouraged in California. I really appreciate innovation being a major part of the agency.
My name's Campbell Gibson. I'm head of policy at Avant, and I feel like we're on the Shirley MacLaine panel up here talking about past lives. In my past life, I worked in the Senate on drafting Dodd-Frank, and then in Treasury for a number of years implementing Dodd-Frank. And I think what California is doing is not dissimilar as to what happened with Dodd-Frank, in that you're taking a lot of vestiges from many different pieces of past legislation and regulation, and then saying we need something that's holistically approaching the financial services industry. And so they start with it's somewhat different because in Dodd-Frank you were consolidating a lot of agency authorities into a single agency. This is somewhat different because you're essentially just remapping the authorities of the agency that's currently overseeing these activities. But I do think conceptually what they're trying to do is look at that the financial system is evolving. Clearly, innovation is like squarely within the aim of this legislation, but they're saying we need to be looking at this from a holistic standpoint, as Armen was saying, not just activities, but products. And I think that that's an important thing that both Dodd-Frank and this legislation share, is they were saying, we need to look at this and give authorities that allow responsible products to be differentiated from irresponsible products, and basically move forward in a way that we understand the financial services industry is changing, but essentially give the commissioner, and Commissioner Alvarez clearly has a strong background in the CFPB and deep understanding of what their mission and goals were, and so invest in the commissioner the authorities by which to make those distinctions and allow the financial services industry to move forward and innovate, but also do so in a responsible way.
Well, you all are so right. Innovation is in the name of this new proposed agency, and clearly they want to, fund that, including an office here in San Francisco just dedicated to having outreach to all sorts of stakeholders, not just industry, but also consumer advocates. I think technologists too is part of the vision. Hopefully we'll hear more about that later. But often, the concern is that saying innovation is a core part of, a new product or service. It's just a fig leaf for trying to get around existing regulations. So how do you think, with a regulator who wants to incorporate both consumer protection and innovation, like what's the vision from your different perspectives about how that could play out in a way that accomplishes both those visions?
I might view that's the opposite in some ways, to be honest with you. No one's asking for an office of immunity. We should not think of Office of Innovation as this like freewheeling sandbox. We should think of an office of really information sharing is what you think of it as. And if the opportunity to come to a regulator doesn't exist, to discuss what you're trying to accomplish and how it's helping borrowers in the lending space, for example, and how you're responsibly deploying capital, then evasion occurs, and you end up in situations where the conversation is never happening, and then people are skirting laws, not engaging. And I will say, in New York, I do think that we got off the wrong foot in terms of making ourselves seem like an enforcement agency first and foremost. And I think that ended up creating more problems than solutions off the bat, because back when I was there was a time where people communicated to you their efforts and their goals, and you worked with them. If you're not doing that, you can't have the conversation, and now you're encouraging evasion, not discouraging evasion.
I think in my experience, the department has kind of always been, the door has always been open to conversations about business models, but I think that there will be concern, especially with the enforcement priorities of, who wants to kind of stick their head up and call fire on their own position, as it were. If, before this kind of balance is shown, right? And I think that the balance, obviously, it's in the legislation. It's something that is a priority. But I also think that, new market entrants are concerned. I'll give you an example. We do a lot with folks coming in from the UK and Australia, and they think that the 50-state system is insane. I mean, there's just like, what do you mean I can't go talk to one person about this? And what do you mean they can't tell me whether it works or not? If we could kind of create that open door policy, that is enjoyed in some of those other markets, I think that will be a real foster to innovation. But I think that having kind of the enforcement, hammer hanging over is going to maybe chill some of those conversations. I think it's just a reality until it's borne out.
I take a slightly different viewpoint of it. I think that maybe no one would have envisioned, if you started with a blank sheet of paper, no one would have envisioned 4 different banking agencies, and then at the federal level, and then market regulators, and then the whole 50-state solution. But I mean, approach. But it is the system we have, and I think that Dodd-Frank reaffirmed that the state-federal, the dual banking system is important, and they both have very strong roles to play. I think innovation is in the name, and signals that it's important. But I think if you look at what's happened at the federal level, at all of the banking agencies, they've opened offices of innovation, and they perhaps, I'm not sure if the Fed does yet, but they're all looking very closely at this. And I think what it says from an institutional standpoint is this is important, that we understand this, and that it affords resources for staff to take the time. It affords processes for, and this, it's, clearly that's to come in this proposal, but without those avenues for engagement, both from the staff's perspective as well as from industry and other other policy stakeholders' perspective, there's not, it is very difficult for an institution to say we want to engage on these priorities. And I think by putting it front and center, then it does say both that this is a priority for us, and then clearly there's the consumer protection arm, which says, but not at the stake of our existing responsibilities.
And there is in California, especially under the CFL, there is a process by which you can get legal advice about whether something does or does not work in terms of what the commissioner views as appropriate. There's an interpretive opinion process. And, we have our law firm has submitted a number of interpretive opinion requests. There's a very capable staff that is charged with reviewing those, and it's a good dialogue. But I think there would be a lot more of those requests if the industry weren't so concerned about opening the door to a possible enforcement action. I think that's just, those are the conversations we have all the time. And, there is this process. We can get an answer to this. That's wonderful. But no, I have to tell them, I have to kind of reveal who I am. I have to kind of lay it all out there. What's my confidentiality of this once I put it out there? There's no guarantee they're not going to come after me, which I understand. Look, this is all a balancing act, right? But I think that is a real life and present demonstration of the concern, right, and a good process that the DBO has now, but a concern of the other side of the balance sheet on the enforcement side, and getting that clarity and having those discussions.
One wonders, though, if to help temper that, really how it can't be an office in name only, right? Like, it's really easy to like put up a shingle and say, here's our Office of Innovation. Is this office empowered? I mean, at the CFPB, people can criticize their office, and they have. However, I will say they got something really right. I mean, that director reported to the director of the CFPB, and had a line to help set policy. Presumably also had a line and was at the table with the GC, with enforcement, with supervision. I think if it's an empowered office and isn't just put in research or isn't relegated somewhere, but actually has access to Manny Alvarez, assuming he remains in charge and his successors, it can help mitigate some of those concerns. And we wouldn't want to see that office used as a tool of enforcement.
Yeah, look, I don't think this is things that need to be solved in the legislation itself. I think it's just something that needs to be, addressed in how it's set up and executed. I think that a lot of this is going to be establishing trust on both sides.
Maybe I'll just chime in on the innovation question. I don't know that my perspective will be that surprising. I generally speaking, I like innovation as much as the next guy and think that it's a wonderful thing by and large. But that conversation has to happen in the context of what it does to people. I mean, there are a lot of things that were innovative over history that didn't really work out that well. Gunpowder was innovative. Chemical weapons were innovative at a particular period of time. The question is whether or not, from my perspective, whether or not that innovation helps people or hurts people. And if you want to persuade somebody like me that your innovation is a good idea, you got to tell me what you're innovating and whether or not it's actually going to help people. Is the new efficiency going to be built into just making it a more effective debt trap, or is it going to make it a more effective thing that is profitable for the business and also is a reasonable and transparent deal for the customer? And the answer to that question is innovation by itself is neutral on that question, and that's what I'm focused on, is whether or not it helps the customers, helps the consumers. So if you talk just about innovation in a vacuum without, maybe you increase access to credit, yeah, but is it useful credit? Is it suitable for the borrowers? Is the interest rate 500% and they're going to be in a debt trap and just an interest-only hamster wheel for the next 5 years? I don't care if that's innovative. I don't like it, and I don't want it, and I don't want people using it because it hurts them. So that being said, California is such a leader in our country and has been great in a lot of respects in helping us chart a new course for our society. And I think it's important for California to continue to be an innovative leader, and as other states as well, of course. And I think it's a good thing that they're including that as part of the brand. It's too easy for laws to get out of date. It's too easy for these kind of legacy regulations that don't just create transaction costs and don't really help people very much. I find that in a lot of the conversations I have back in Washington and just around the country, that there is probably some more willingness on the part of consumer advocates and progressive leaders to trade away some of these old kind of dead letter laws. But to get those conversations to really happen, somebody from your side has to come forward and provide leadership on what other new consumer protections are going to be offered as a trade. I mean, if the answer is let's just clean up all the old dead letter regulations that provide limited consumer protection and service to innovation with no guarantees that whatever's innovated is actually going to be helpful and beneficial for people, and there are going to be reasonable limitations on predatory products, well, then that's not a deal anybody in my shoes is going to take, and anybody that's actually looking out for customers. I don't really think that's a good deal. But if the answer is, yeah, let's do something innovative, let's clear out some dead letter regulations, and also let's put some real hard-hitting, good consumer protections in place, that's a deal we can do. And that's, I think, part of what was at least guiding some of my thinking, I think some of the other advocates in this California bill.
And I'll just add real quick that Commissioner Alvarez has said that that proposed innovation office to be here in San Francisco is supposed to be very independent and report directly to the commissioner and to help weigh in on the crafting of new regulations or guidance, but obviously not kind of duplicative. At least the vision is not to be duplicative of supervisory enforcement or the other the work done by the rest of the agency, but to sort of add on, but to really be like a strong advocate in some ways for, obviously I don't want to speak for the commissioner. I interviewed him and this was one of the questions that we discussed. So I'm kind of just relaying what he said. So it sounds like the vision, at least right now, is that it would be kind of along some of the lines that you were discussing. So,
Yeah, I also think that, and I agree with what Chris said. I do think that distinguishing responsible innovation versus irresponsible repackaged or new irresponsible products is certainly something that has to be watched out for. I also think that there should be a bit of distinction that it's not all just new entrants. It's not all. If you look at what Comptroller Curry created at the OCC, I think what their goal was not only to look at new models and new products, but also to look at existing long-standing institutions and new means of delivery and new means of engaging with the consumer through a digital product or through other means of simplifying internal processes through the use of technology. And so, I went to an OCC day in Chicago, and there are probably 25 small banks coming, and I think that they look at this in sort of a very this is a lot, and we have very limited resources, and it allows them to engage with their regulator in a way that they can learn about how to do this in a responsible manner. So I think it's not all sort of these new models and new products and new entrants. Sometimes it's the existing institutions that have been 100 years old, but they just want to engage in a different way.
I think I'm going to try to tie Chris's comments to the first panel today, not to reopen that, but I think it's really important. I think Nat might have sat in this seat when he said how an industry, marketplace lenders, have come together to actually try to do just what you're saying, which is create new industry standards. There are now 12, if not more, loan facilitators and dozens of other folks in that association, calling ourselves marketplace lenders, subscribing to actually maybe we read your article in the Law Review from 10 years ago saying we should have a 36% cap. That's it, plain and simple. There are a lot of vestiges. We might have overread that article, but we decided that we were going to stick to a 36% national standard. And in turn, we'll provide the innovation of transparency, of longer-term products, no balloon payments. And I know our data at Lending Club shows that we're reducing credit card rates significantly. We see 5 percentage point declines. We see saving people $1,000 to $3,000. And in fact, we want to even provide more than we want to provide in the name of innovation is opening up our books. So we've asked the Federal Reserve to come in, look at our data and publish on it, use this as a proxy for the marketplace lending industry, since we were one of the founding members and perhaps the largest. And what they found is by looking at our data, they've proved that we are lowering the cost of credit and reaching down into FICO to bring more people into the banking system through our bank products, while not increasing default rates. They've also found that we're penetrating LMI areas, especially where banks are pulling out drastically. We're able to help unbanked. 40% of our loans is going into areas where I think most of the bank branches are pulling out, is what they found. So I think we got to open our books. We got to make great products. We got to create industry standards. And we got to talk to these innovation offices about what they can do to make sure that we're not stuck in the old way of doing things, where only credit cards, where people can only use credit cards, but we had a new way where people have a lot of other products that are better for them and more healthy.
Yeah, I would agree with that. I think that the innovation is driving competition in a way that predatory products are really put at a disadvantage, and because I think awareness to consumers, access to credit that's at their fingertips is, and people are going online and seeing head-to-head comparisons of what credit looks like. I think those type of innovations are, especially in the post-crisis U.S., where you have branch banks pulling out of rural areas, pulling out of inner cities, LMI borrowers see fewer options as far as bank products in their neighborhoods. And so I think that these are essential, but it's not to say that there aren't, predatory products out there. And I think that, what Commissioner Alvarez is considering here is distinguishing what is responsible from what is irresponsible products. And that's an important regulatory approach, supervisory approach.
Sure, since we have an audience question, go ahead. And speak loudly, and can you say your name and who you're with?
Dan Wheeler, Cred, we're a lender. I have a real concern about this CFPB approach being brought to California and this idea that the subjective opinion of the regulators will decide whether or not a particular product gets to launch or not. The CFPB's approach was to interject its opinion regardless of what the law said. So it was no longer good enough to just design a product that was lawful. It had to also satisfy the subjective values or opinions of the regulator. So that sort of subjective regulatory approach will mean that only the largest incumbents will survive in California. Only the largest banks, only the biggest established companies, because no one else has the resources to advocate and spend all the time to prove that not only is it lawful, but it meets whatever you happen to think of on a particular Tuesday is responsible.
I don't know if someone wants to respond.
Yeah.
Yeah, go ahead.
I mean, so for those that may not have heard it, the premise of the question was that the CFPB was applying its own subjective preferences about whether or not a product was acceptable that were above and beyond and sort of decoupled from what was lawful. I guess I don't know what you mean by subjective, and I don't know. When I was there, I remember trying to be pretty clear and focused on what the law said, but there are some flexible standards in federal law. The Congress passed a law that said that what's unfair and what's abusive and what's deceptive, that's not permitted in consumer financial services. They did that because, you call 10 years ago, 15 years, whatever it was, 2008, a good chunk of the nation's banks were insolvent, and the largest forced migration in American history occurred as millions of people were forced from their homes. It caused a spike in the national suicide rate that caused a 50% increase in the number of homeless children in my hometown. And so to the notion that we don't need some sort of consumer financial protection or some flexible standards to try to make sure that our products are working for the public is false. People die when there are not safety standards built into our financial services. And I get that sometimes it's hard to intuit what the right answer is out of those flexible standards. It creates compliance challenges. You need good lawyers, you need good counsel, you need good judgment. It's hard to do business. It's also hard to be a regulator that tries to protect folks. But that was the charge that Congress gave the Congress, and it was overwhelmingly supported by the public, and it still is.
I'll just add that that I think that kind of lack of prescriptive standards just creates inherent inefficiency, and we can debate about the value of that. But I do think that as a practical matter, the department has used its judgment. It's not like they're, it's not like the law like the CFL is super clear. I'll give you an example. Lead generation. Well, the department didn't go after lead generation until a couple years ago. And I certainly thought that a lead generator didn't negotiate loans, but I guess, that's a flexible standard. I think that what this legislation does is it provides a little bit more cover for the department, or a lot more cover for the department to do things that it's already doing in a lot of different places. And so, I mean, yes, I think this is going to be a big change. There's going to be a lot going on. There's going to be a lot more registrants, but it's not, it's not something that is completely foreign to the regulators in California.
So I've got a question on enforcement, but I'm going to go to a few more audience questions. Go ahead.
So this might be for you or the whole panel.
And say your name.
Sorry, Scott. Scott Brooks, Quicken Loans. When it comes to things that are named, there are a lot of things that have a thing in a name, and it's a misnomer. A healthy choice is still a frozen meal. Having innovation in the title of this thing doesn't necessarily mean it is innovative. And they said that a lot of this is trying to make sure that they are understanding of what products they are regulating. Like, we want to make sure we're up to snuff on the new fad, the newfangled thing. And it's funny because I didn't know you wrote this article until just now. I read it and I'm like, cool, this sounds a lot like they want to do a fintech regulatory sandbox. And they very much don't want to. And so I ask you if this is about innovation, if it's about coming to business and getting responsible products out there, and not just about preemptive enforcement actions by having you kind of self-report. Why not go that next step and say, okay, we want to establish something, a safe place where companies can be innovative, can be responsible, so things like 2008 don't happen, but can still be done with good, sound regulatory oversight.
Well, look, I get that sometimes things are misnamed. So, for example, in the economy right now, there are a lot of loans that are called fast cash loans that are really debt traps, right? That's what they really are, and they're misnamed. So that happens on both sides. I worry a little bit about sandboxes, frankly, because I don't know that who is it that gets to decide whether or not those products are responsible and how much of the market starts getting channeled through that sandbox? I feel like sometimes I worry that the word sandbox is like, it's like it's another misnamed product that really it's just, we're gonna call it a sandbox. We're just gonna play and nobody gets hurt in the sandbox because we're all just good kids, and it's always gonna be responsible. Well, if that's really what it is, then fine. But if what it really is, in fact, is like a new way to create, rent a bank 2.0, where we're gonna have 300% interest rate loans that are being exported all across the country with arbitration clauses and class action bans and no ability to pay underwriting and, staggering the way that they force through ACH items into the consumer's bank account, so you're jacking up a whole bunch of insufficient funds, fees, and overdrafts. So if that's what's in the sandbox, I'm not down with that. And how do we make the decision about what gets in that sandbox and what doesn't? That's a really hard question, and I don't know that I really have all the answers for that. But what I can say is that I certainly empathize with your desire to bring good products to market, and I support that and want to, not that it matters what I think. I'm just some teacher in Utah, but I'm cheering for you. I will also say there are a lot of good products out there that. And let me just give you some examples. You wouldn't think that I'd be a fan of Goldman Sachs, but their Marcus product and their Apple Card, there's a lot to like there. No fees, very vanilla, they're trying to do some risk-adjusted pricing. How do I get my claws into Apple Card? Some journalists tried to get me to say something bad about it, and I would direct, it's not, I couldn't think of anything. It was fine. I don't know. I don't have anything to say about that. So there's something innovative, and they innovated through simplicity and through, making sure that they had some reasonable standards. So I don't know.
But then they got caught up in an investigation with.
That is true. I obviously I couldn't at the time that my anecdote there. I don't have any line of sight into the back room of what their algorithms are doing and credit lines. But something tells me that at the end of the day, that'll get sorted out probably pretty well.
Sorry, did one of you?
I think you go ahead.
No, I was just going to say, I think that the big shift here is going to be, the big shift is going to be pulling these other industries in that haven't been regulated by the department, because the first, response is, well, we're not covered by the CFL, that goes away. I think that's going to be the most practical, immediate effect.
Sorry. I also think that in a dual banking system, that sandboxes are a bit of a misnomer, because California could give you a pass and the CFPB may not. So I think that, I think that a regulator that wants to work on innovation is signaling that they're interested in not just keeping status quo, and maybe they're not creating sandboxes, but I do think that they're, to have regulatory staff that's focused on innovation is a very different thing than one that says that the current system is the right, the exact right answer.
So I see a question from the gentleman in the red sweater.
Two questions, please.
Say your name and.
Jordan Hunowitz. First is, how is the person, is he nominated or appointed? How does it work on the new head of this organization? And second question, to your statement now, industries that will now be inside this organization. One of those is rent to own, and rent to own, especially third party, is charging consumers 150, 200% interest rates as a disguised installment product. Well, I noticed that was in for the first time, only like Wisconsin and Minnesota have that. Is that a targeted focus, and how did that get put into this?
Well, I wasn't involved in drafting it, but I'd say that on the first question, I think that the commissioner of this new office is the same as how it's done now, which is there's an appointment by the governor, which is then they're just then confirmed by the California Senate. Actually, Commissioner Alvarez, I think, is being confirmed in the next week or two. Maybe it's this week. As to your second question, I think that there's going to be a number of business lines that have been traditionally outside of, factoring would be an example as well. Factoring, the department used to have an FAQ or something on, I think, its website that said factoring wasn't covered, and then there was some colloquy in the Senate that said it wasn't. But then, the new legislation kind of brings it in on the disclosure side. I think that will be squarely in, right, with this new legislation. And then I think there's going to be a number of those types of business models that are going to be priorities because they're just, I think that maybe the interest rates or the equivalent to what the interest rate is way outside of what the department is comfortable with, and or maybe how it's sold is not going to be consistent with this new UDAP standard.
I do think that your point about products that exist outside of specific state regulation that maybe usury caps, I think the last panel addressed that well, and I think that those need to be a focus, and that looking at responsible products needs to be a holistic approach, and that there clearly are a lot of exceptions under state laws that leave people exposed, and so you end up with this donut hole where you might have a state rate cap and then you have an extraordinarily high approved product, and there's this sometimes 100% gulf in between there. So it's like you're under this, but you can't get under 36. You might not get a 27% loan, but you could get a 127% loan. And I do think that that's an important debate. It's not exactly this panel, but it is an important. You raise an important.
But it is a
point.
reason why haven't disagreed with Chris on this panel yet, but we can find reasons why Apple Card and what Goldman Sachs is doing isn't a great product, and we do think the installment product is far superior.
And it's going to be hard to find where the safe zone is, I think. Another example is litigation funding, right? So litigation funding kind of has traditionally been outside of traditional CFL, which is the closest law kind of to it. But there have been enforcement actions that prescribe, we're agreeing to make these disclosures as part of our product, but there's no blessing by the department that it's okay. There's no, and I'm wondering kind of going forward where things like that are, are maybe not traditional. Is it really going to be, as we saw in the case of the CFPB in the early years, kind of a regulation by enforcement situation where you have like a lot of, enforcement going out there, or is that dialogue going to be open enough that we can avoid that scenario?
So in the last few minutes.
Chris, I know you want to respond to that.
Oh.
Well, those are my cases. I don't know. I don't know. I've never understood this term. It doesn't mean a lot to make a lot of sense to me. I mean, there were enforcement cases, and then there were some settlement agreements, and sometimes those settlement agreements had some standards, and folks are worried about whether or not their business practices were outside the standards in the consent orders. But that's not the same thing as doing a notice and comment rulemaking that everybody has to comply with. And were there a couple of cases that were maybe a little innovative, maybe that cash call case or something like that? Yeah, there are a few cases that kind of pressed the boundaries a little bit, but I just never, and the CFPB lost one or two, but they've done 200 some odd cases, and I think they've lost maybe, I don't know, 4, 5 cases, something like that now. So I know that that's a label that gets thrown out there, and I get that I just sometimes feel like that's you disagreed with what the law was. And one of the things that I find it happens on my side too. We consumer advocates get together, we all talk to each other, and we get groupthink that starts happening. I think that happens for you all too. You go to the conferences, you all talk to lawyers, shop around to different businesses, and before you know it, you all conclude that, for example, a bank can transfer its status as a preempted interstate lender to everybody else. I never agreed to that, and it doesn't say it in the statute, at least not very clearly. And it turns out the Second Circuit, 2 judges on the Second Circuit agree with me. And so everybody can get. But if you do something like that, and then everybody says, it's regulation by enforcement. Well, how about it was just groupthink by industry, and you learn that actually not everybody agrees with you about it. I don't know.
I think
I'm sorry.
one of the.
I'm sure I offended everybody in the room. My bad.
Offended completely.
Well, one of the challenges is, right, it's not a level playing field, right, as between the industry actor who's being challenged and the regulator, right, and and a lot of people don't want to go to the mattresses with their regulator over things. So you'll see enforcement actions that may not necessarily reflect what the industry thinks the law is on that particular issue, but the client doesn't want to go to the mattresses on it because it's really expensive, and they don't want to make an enemy of their regulator. And that dynamic is just kind of one of the realities of the regulated financial system in which we live.
I'm going to go super quick if we can. I see Eileen has a question.
Yeah, it's a statement. I hear a lot of optimism, cautious optimism about what the new department's going to do. I just want to offer a thought on timing. If you read the budget change proposal, this evolution of DBO into DFPI is really a minimum of a 3-year evolution. The first year they want to hire 44 new people, and then over the course of 3 years they're going to hire up to 90 new people. And then simplifying it, the first year they're going to do a bunch of hiring, the second year they're going to do a bunch of rulemaking, the third year it sounds like they're going to start the registration. So if folks are looking for guidance, I think we should expect to see that beginning 2 years from now rather than immediately.
Yeah, and I think that goes. I mean, that's very helpful. I think when I read the budget proposal, one of the things that struck me, just being in the weeds on the licensing stuff, is that the DBO expects to register 9,000 registrants annually, which is a whole lot. So 3 years is a good timeline for that.
9,000. It'll be 18,000. It'll be 4,500 years, and we'll be done.
Sounds like your practice will be busy.
So with those numbers, we're going to leave it there for our final speaker. Thank you to the panelists.
Thank you, everyone.